Hi, in this video, let us see how the family pension income works. So first of all, who will be receiving the family pension? Family pension will be given to the person who was already getting a pension on monthly basis, or it could be for the person who passed away during the service of his employment. Then and if he is eligible for pension, that amount will be moved on to the next family member. It could be the wife or the children. So when we say this family pension income, is this taxable or is it exempted? That is what we are going to look into this video. The Act says that if you're receiving any pension income on behalf of a deceased family member, then it will be taxable under the head of income from other sources. And we are also eligible to claim a deduction of 15,000 or one third of the amount, whichever is lower out of these. And there are certain exceptions in respect of the family pension. Let us look into that. So the Act says that a family pension received by the widow or the children or the nominated heirs of any armed forces of the Union where the death of such member has occurred in the course of its operation duties. And it also says that the pension received by any member of family of an individual who had been in service of the central government and has been awarded Paramveer Chakra, Mahavir Chakra, Veer Chakra or other notified gallantry awards would be exempted under this Act. Otherwise, any other persons who's getting this pension, the family pension is subject to the tax. So just let's look into a simple example. Suppose in case a family pension is paid of 50,000 rupees for a family member. In that case, we have to calculate it as 50,000 into 1 divided by 3, which is coming up to 16,665, and the standard deductions which is allowable under this is 15,000. So if we compare 16 and 15,000, we can see that 15,000 is lesser. So 15,000 will be reduced out of this 50,000 and the balance amount will become taxable. So that is 35,000 will become taxable. As I mentioned earlier, the income which you are receiving towards a family pension is supposed to be declared in an income tax return, and the return which we'll have to choose is income tax return to ITR 2, and it has this particular income has to be declared under the head of income from other sources. Okay, there are two types of pension. That is commuted pension, which is paid in one lump sum amount, or it's an uncommuted pension which is paid on monthly basis. Let us see in detail about this. So this is how the exemption has been calculated on the pension income. When you're getting a pension and if it is an uncommuted pension, that is you're receiving it in one lump sum, then the full amount is taxable for the employees or the person who's receiving that income on behalf of an employee. When you're seeing a commuted pension is exempted for the government employees and is partially exempted for other employees, that is one third of the pension in case of the receipt of gratuity. Also, in case if the person is in any other cases, then the commuted value of the half of the pension amount is taxable. Here's a small example to describe about how this actually works. Um, Alex died on 31st July 2022 while being in central government services. In terms of rules governing his services, his widow, that is Mrs. Alex, is paid a family pension of 10,000 rupees per month and dearness allowances of 40% thereon. State whether the amount of family pension is accessible in her hands, and if so, under what head of income can she claim a relief or deduction on such receipt. Compute the taxable income for the assessment year 2023-24 and thereon. So this is how it is. First of all, we should mention what is the income which is getting it across. So as we can see that she is getting 10,000 rupees plus 4,000 rupees as an DNS allowances, that is summing up to 14,000. And as Alex is passed on 31st July, whatever the leftover months, we'll have to consider that and multiply it. That is 8 months into 14,000. You'll be getting 1,12,000. And the standard deduction says that one third of the pension. So that is 1,12,000 divided by 3. You will be getting 37,333. And the standard deduction limit is 15,000. So whichever is lower, we'll have to consider that for the deductions. Here I can see we can see that 15,000 is lesser. So out from the 1,12,000 you have to reduce 15,000, and the balance amount 97,000 is a total income. Tax on the above income is nil because it's not crossed the limit. Here's one more example. Mr. X is getting a family pension. Mrs. X is getting a family pension of 7,000 rupees. Compute the tax liability in case if she's opting for a new regime or the old regime. Per month she's getting 7,000 rupees, so per annum the income is around 84,000, and as per the act either one third or 15,000. So one third is coming up to 28,000 and 15,000 is the standard deduction, so whichever is lesser, that is 15,000 is lesser. And so we have to reduce 84,000 minus 15,000. So whatever the balance amount is left over, that is 69,000, is taxable income in terms of old regime. In case if she's opting for a new regime says that there is no deductions allowed. So here 84,000 whatever she is receiving it, that will be the taxable amount. I hope this is clear. In case if you have any doubts, please drop in a text or drop in a comment on the comment so that I will get back to you with the response.